Two people, same salary, same savings, same starting point. One of them is going to build serious wealth, almost on autopilot. The other is going to deal with tenants, repairs, and real stress for the next 20 years. And here is the part nobody tells you. One of these paths looks smarter at the beginning, but ends up being the wrong choice for most people. Ryan and Devin are both 28. Same city, same $60,000 salary. Both just hit $50,000 in savings. The only difference is what they do with that 50 grand. Ryan goes to a real estate meetup, talks to some guys in polo shirts, and walks out convinced. He puts $50,000 down on a $250,000 rental house, 30-year mortgage at 7%. His payment is $1,330 a month. He finds a tenant at $1,800. On paper, that is $470 a month in profit before he spends a single dime on anything else. Ryan feels like a genius. And on paper, he might be. In reality, it depends entirely on what happens next. Devin takes the exact same $50,000 and drops it into a total market index fund. Sets up an automatic $300 a month contribution. Logs out. Does not think about it again. His coworkers ask what he invests in. He says index funds. They nod and change the subject. Nobody is impressed. Ryan has a house, a tenant, and a story. Devin has a confirmation email. It is not even close in how it feels. But here's the thing about feelings. They are terrible at math. The first couple of years, Ryan is living the landlord fantasy. Rent hits his account on the first. He drives past the house on his commute, writes off depreciation on his taxes, and tells everyone who will listen about his cash flow. Something real, something tangible. Devin logs in once a quarter. The number goes up a little, dips, goes back up. Year 1, $55,000. Year 2, $61,000. Nothing exciting. No key in his pocket, just a number on a screen. Ryan wins every dinner conversation. Devin wins none. And that social proof is exactly what pulls people in. Here is what the numbers actually look like. Over 3 years, Ryan collects $64,800 in rent and pays $47,880 in mortgage. The gross gap looks like $16,920 in profit. That is the number people put on the napkin. That is the number talked about at the barbecue. Then reality shows up. Property taxes, $3,000 a year. Insurance, $1,500. A water heater breaks, $1,200 gone. A roof leak, $2,800 gone. 1 month of vacancy costs $1,800 in lost rent plus $600 to clean and relist. And Ryan manages the property himself, which means late night texts, weekend showings, and contractors on his lunch break. After every real cost, his net cash flow over 3 years lands between $2,000 and $4,000, not $16,920. And that is actually a decent outcome. In a worse deal, this could easily be zero or negative. That number does not include a single hour of his time. Devin is sitting at about $76,000. 0 phone calls, 0 emergencies, 0 weekends at the hardware store. Now, before you write Ryan off completely, there is one thing Devin simply cannot replicate: leverage. Ryan used $50,000 to control a $250,000 asset, 5-to-1. When the property appreciates 3 to 4% a year, his equity grows on the full $250, not just the $50 he put in. By year 3, the house is worth around $275. His equity has climbed to roughly $60,000. That is real wealth, built on the bank's money. The stock market cannot do that. But leverage also means every vacancy month and every repair still hits you whether rent came in or not. And the repair list never stops. Maintenance alone runs 1 to 2% of property value every year. On a $250,000 house, that is $2,500 to $5,000 annually. Some years it is a $200 faucet. Other years it is a $7,000 HVAC replacement in August when your tenant is texting you at 9 p.m. and threatening to break the lease. And the big ticket items are guaranteed: roofs, furnaces, water heaters. Every one of them has an expiration date. Every one of them costs between $5,000 and $15,000 when they go. If you are not saving for them every single month, you are not running a business. You are gambling on everything going right. By year 5, Ryan is on his third tenant, has replaced the roof for $8,500, absorbed a plumbing emergency at $1,400, and lost another month of rent. He raised rent to $1,950, but taxes and insurance went up too. His real cash-on-cash return is hovering around 3 to 5%, not the 20% he mentioned at the cookout. This is the moment most people underestimate. Compounding is boring for the first 5 years and genuinely astonishing for the next 15. Devin at year 7 is at roughly $140,000, still doing nothing. The gains on his gains are now generating more new wealth each year than his monthly contributions ever could. Here is what year 10 looks like, side by side. Ryan's property is worth about $340,000. He owes around $176,000. Equity, roughly $174,000. But he also spent an extra $25,000 to $35,000 out of pocket in repairs, taxes, and vacancy beyond his down payment. Devin's portfolio sits at approximately $170,000. Total invested $86,000. The rest is pure compounding he never had to manage. Almost even. Ryan slightly ahead on paper because of leverage, but Ryan worked for every dollar. Devin let time do the work. Ryan took on debt and concentrated risk in one property. Devin owns a piece of thousands of companies across the economy. Same result, very different experience. And this is where most people make the wrong call. Because Ryan looks like he is winning, but the hours, the stress, the debt, and the concentration risk are invisible in the headline number. Year 20 is where the truth comes out. Ryan's equity lands between $400,000 and $500,000. Mortgage nearly gone. After 20 years of repairs, turnover, taxes, and at least one major renovation, his net profit above real expenses is roughly $40,000 to $80,000. Earned. Every dollar of it. Devin's portfolio at 10% average annual return sits at approximately $430,000 to $460,000. He put in $122,000 total. The other $300,000 plus is pure compound growth. No debt, no tenants, no calls at 2 a.m. about a broken pipe. Similar outcome, completely different lives. And here is the uncomfortable truth. Most people would have been better off choosing Devin's path. Not because real estate is bad, but because most people do not treat it like a business. They underestimate costs, they overestimate cash flow, and they quit when things get hard. Stocks are not a free ride either. Markets crash. In 2008, the market fell 37%. Most investors panic sell at the bottom and buy back after the recovery, locking in exactly the wrong outcome. And unlike real estate, there is no monthly cash flow, no depreciation deduction, no 1031 exchange. Real estate has structural tax advantages stocks simply cannot match. So after running 20 years of real numbers, here is the honest answer. Real estate wins when you treat it like a business, screen tenants carefully, and operate in a market where rent actually covers the real costs. Index funds win when you value your time, want broad diversification, and can stay out of your own way during downturns. Both build serious wealth over 20 years. The difference is what you trade for it. The trap is not real estate. The trap is not the stock market. The trap is picking either one without ever running the full numbers for your own situation. So here is the real question. Which one would you actually stick with for 20 years? Because the best investment is not the one with the highest return. It is the one you do not quit.